What if the stock market crashed tomorrow? Would you be ready? Would your money survive? Or would you wake up to find half your net worth wiped out before breakfast? Because here's the thing nobody wants to say out loud. Crashes don't send invitations. They strike fast and they hit hard. And if you're not ready, you're just another victim in Wall Street's favorite blood sport. Think it can't happen? Oh, it can, and it has. The 2008 financial meltdown erased $7.4 trillion in U.S. stock market wealth in just 18 months. Black Monday in 1987, the Dow plunged 22% in a single day. Even March 2020. Remember that free fall at the beginning of the pandemic? The S&P 500 dropped 34% in less than 30 days. That's not just a dip, that's financial whiplash. But here's what they don't teach you in school and what most influencers on your feed never talk about. Market crashes aren't just random. They're built into the system. Yeah, you heard that right. The entire stock market is a fragile house of cards held together by emotion, algorithms, and trillion-dollar egos. And when one piece slips, boom, it all starts crumbling. Now brace yourself, because we're standing on a ticking time bomb. Inflation's still sticky. Interest rates are sky high. Corporate debt is surging. Consumer debt? At an all-time record. Even Warren Buffett's favorite market indicator, the total market cap to GDP ratio, is flashing red. It's like not just warning red, but we're talking siren blaring, DEFCON 1 Mayday-style red. And still, people keep YOLOing their paychecks into meme stocks like it's 2021. Let's be clear. If the stock market crashes tomorrow, 401ks will shrink overnight. Pension funds could collapse. People might lose jobs, homes, and even their sanity. It's not just about losing money, it's about losing stability. But here's the wild part. While most people panic during crashes, the wealthy, they celebrate. Why? Because crashes are discount seasons for billionaires. While the average person is panic selling their future for pennies, the rich are scooping up assets like they're at a clearance sale. Just look at the data. After the 2008 crash, people who bought into the dip and held saw massive returns. Amazon? Up over 3,000%. Apple? Exploded. Tesla? Don't even get me started. But here's the twist. The people who made those moves weren't emotional. They were prepared. So the million-dollar question is, what should you do right now to not just survive a crash, but potentially come out of it richer than ever? Because make no mistake, a crash isn't a matter of if. It's a matter of when, now. If I were diving straight into the first 24 hours of a market crash, what happens, who reacts, and why the first few moves you make can either destroy your wealth or set you up for generational success. This isn't fear-mongering, this is your wake-up call. Stay locked in, all right, it's day one. The market just crashed, red everywhere. Stocks are nosediving, CNBC is freaking out, and your portfolio. It looks like it got mugged in an alley. People are logging into their accounts just to scream. But while the average investor is spiraling, the smart ones, the prepared ones, are already executing. So what exactly should you do in these first 24 hours? First rule, don't do it, not panic. That's the most expensive emotion on Wall Street. History proves it. People who panic sold during March 2020 missed out on one of the fastest recoveries in stock market history. The S&P 500 not only bounced back, it soared, but only for those who held on. Think of it like turbulence on a plane. The worst thing you can do is jump out mid-flight. Now second, check your cash. This is your emergency parachute. The ideal sweet spot? You want at least 3 to 6 months of expenses in liquid cash, parked in a high-yield savings account or money market fund. Why? Because if things get ugly, layoffs, freezes, credit tightening, you need to buy time. Cash isn't trash during a crash. It's a weapon. Third, stop checking your account every 5 minutes. That's like standing in the rain, getting mad you're wet. Volatility is brutal during a crash. Stocks can swing up and down by 10% in a single day, and most of it is noise. The algorithmic traders are feeding off panic, and your clicks are just fueling their game. Now here's where it gets juicy. The secret move that rich investors are already doing on day one. They start buying. Yup, not recklessly, but strategically. They've got a list. It's called a watch list, filled with high-quality companies they've been eyeing for months. Apple, Microsoft, Google, Amazon, dividend aristocrats, recession-resistant giants. And when prices drop by 20%, 30%, 40%, it's game on. You don't wait for the news to say the bottom is here. Because by the time they do, the bottom's already gone. Legendary investor Peter Lynch once said, "Far more money has been lost preparing for crashes than in the crashes themselves." Think about that. The real danger isn't the crash. It's being unprepared, frozen in fear, and missing the rebound. Also, pay attention to asset allocation. If you're 100% in stocks when the crash hits, your portfolio's gonna feel like it went through a blender. But if you're diversified, some in bonds, some in gold, maybe even a sprinkle of real estate, you've got shock absorbers. And guess what? Bonds often spike when stocks crash. It's not just about surviving. It's about having the flexibility to move while others are stuck. And one more thing, thus avoid margin like the plague. If you're using borrowed money to invest and the market drops, margin calls will wipe you out faster than you can say liquidation. That's how millionaires become broke in 48 hours, no joke. Now, most people think they'll be rational in a crash. But here's the truth. Your brain goes full caveman mode, fight or flight. You see red numbers and your instinct screams, sell everything. That's exactly what the system wants. That's how the rich get richer, by feeding off your fear. In Chunk 3, we'll talk about exactly what happens in the days and weeks after a crash, how the market manipulates your emotions, and how billionaires use specific tools, like tax loss harvesting and dollar cost averaging, to actually turn chaos into pure opportunity. Buckle up, it's about to get even crazier. So the crash has hit, the dust is just starting to settle. And this is where the real game begins. Because while you might be refreshing your portfolio every hour, billionaires, they're playing chess 5 moves ahead. And you better believe they've been waiting for this moment. Let's break down what's happening behind the scenes right now. First, let's talk tax loss harvesting. Sounds boring, right? Wrong. This is one of the slickest wealth-building moves ever. When a billionaire sees losses, they don't cry, they smile. Why? Because they can sell losing stocks, lock in that loss on paper, and use it to offset gains elsewhere. Meaning, they pay less in taxes. Sometimes 0. They're turning red ink into a tax loophole buffet. And get this, they often buy back a similar stock right after, keeping their portfolio strong while legally avoiding Uncle Sam. Genius? No. It's just the game, and they know the rules. Now let's hit dollar cost averaging, or as I like to call it, wealth building on autopilot. Instead of dumping your cash into the market all at once, smart investors keep investing the same amount at regular intervals, no matter what the market's doing. That way, when stocks are cheap, you're buying more shares. When they're expensive, you buy fewer, but over time, you average out the cost and build a fortress. This method has been proven over and over to beat emotional investing. It's like planting seeds in a storm, knowing that someday the sun's gonna come out. But wait, it gets deeper. In times of crisis, the Fed steps in. QE, rate cuts, liquidity injections, you name it. The system is literally designed to save the market, because if it crashes too hard, pensions collapse, banks break, and the economy catches fire. So when everything looks darkest, guess what? Smart money starts moving in because they know a bounce back is coming. They don't rely on hope, they rely on history. And what are most people doing during all this? Scrolling through TikTok, asking if they should sell their index fund. Let me be blunt, that's exactly how banks and hedge funds keep people poor. The average investor panics and sells low. The rich buy that fear and ride it back up. That's not luck, that's systematic. Also, let's not forget real estate. After every crash, there's a domino effect. People lose jobs, can't pay mortgages, foreclosures spike, and suddenly, properties hit the market at massive discounts. Who's waiting? Institutional investors, hedge funds, wealthy families. They swoop in, buy properties in bulk, and guess what? When the economy recovers, they're sitting on gold mines. And yeah, sometimes they rent it back to the same people who got forced out. That's not a theory, that's happened over and over from 2008 to 2020. It's brutal, but it's real. Now here's something that'll blow your mind. During every major crash, from the Great Depression to the COVID dip, the top 1% didn't just recover, they got richer. According to the Federal Reserve, billionaire wealth actually grew during the pandemic crash. Think about that. The world was locked down, markets were tanking, but the wealthiest people, they were stacking cash. Not by working harder, but by knowing exactly what to buy, when to buy it, and having the guts to act while everyone else was frozen. So ask yourself, are you